Hi, I'm Steve Taddie, Chief Economist with Hoyle Cohen Wealth Management. Welcome to another edition of Econ Updates. Now, there's been a few items in the news, and one of the big items in the news is when will the Fed cut rates? Now, you must have been sleeping under a tree somewhere or related to Rip Van Winkle if you missed the headlines and the ensuing discussions on the topic. The timing has oscillated a bit over the last few months as inflation data kept heating up. This month's report broke that trend. Other high-frequency economic data chimed in, showing slower activity. Now, our expectations remain for 4 cuts in the next 12 months, 2 this year and 2 in the first quarter of 2025. When they start? June, July, September. It's not that important. And could it wait till after the presidential elections? Sure. But the Fed will take heat either way. So if they feel it's time, my sense would be that they would make the decision regardless of the date of the election. Now, bottom line, short-term rates will drop. The question is when. This will help small businesses that are bank borrowers at variable rates and hinder savers heavily relying on short-term instruments for their income. Productivity gains. The weak GDP report impacted productivity and the employment cost index. That's a data point derived from wages and output. A downturn in output puts upward pressure on ECI. We will get a revision to the first quarter GDP report next week, which will also likely revise the productivity data. Many are expecting an upward revision to the GDP data. Now, going to the markets, we're at all-time highs on the shoulder of earnings per share growth expectations for 2024 and 2025, which stand at about 11% and 14% respectively. Now, for the month, mid and small cap companies turned in better performance than the S&P 500 after lagging for a number of years. International and emerging markets also turned in better performance than the S&P for both the last month and the last 3 months. But the S&P gets the headlines. Longer-term interest rates continue to trade around the midpoint of the trading range, or about 4.4%. It'll get a little more exciting in the bond market when short rates fall below longer-term rates, but for now, a good strategy is to focus on securing the best return for the next 12 months rather than the next 2 months. Sometimes it's better to be a bit proactive than reactive. Going forward, we're keeping an eye on the data that will alter the employed consumer strength that we have enjoyed, alter the productivity growth that we expect, and alter the monetary policy changes we expect to see over the next 12 to 18 months. Well, that's all for now. Thanks again for tuning in.